So, Jonny, we've discussed sovereign bond markets for the last 25 odd minutes. I want you to summarise what you've said and what you think going forward.
Very simple. I think the era of low and stable inflation, low interest rates, and investors able to get positive real returns out of long-dated sovereign bonds ended with the pandemic.
Yeah.
I think this is a very different world. We have frequent supply shocks, a deglobalized economy, demands on investors' capital from fiscal deficits that remain wide, and as well from the capital needs of the private sector. So I honestly don't think, even though yields look very attractive now, I don't think it's the right time to park your money in long-dated sovereign bonds.
Hi, welcome to another Super Macro podcast. My name is Elvis. Sitting opposite me, ex-hedge fund manager Jonny Matthews and the heart and soul of Super Macro. Hi, Jonny, how are you doing?
I'm all right, thanks, Elvis. How are you?
Yeah, I'm okay. I've got one subject I want to discuss today. Long-dated bonds, sovereign bonds, can't catch a break. That's the subject we're going to discuss today. That's going to take us through to the end, I think. There's quite a bit to go through. Look, Jonny, the one thing on my mind, I looked at the data coming through in the last week or so, and we saw the non-farm payrolls miss. We saw a benign CPI and PPI print.
Yep.
Then we saw Friday's retail sales, and they underwhelmed. Sovereign bonds caught a bid and then immediately sold off. What happened there? Why?
It was quite surprising, to be honest. As you know, I've been running short positions in treasuries for quite some time.
Did it surprise you that it happened so quickly, that they rolled over so quickly?
Absolutely. I mean, I stopped out of some of my position.
They had to get back in again.
And got back in again. It was astonishing, really. I mean, the retail sales were missed across every aggregate. You could look into the data and you could say, well, it wasn't quite as bad because Amazon held their Prime Day in June instead of July this year. So, you know, some of the sales were pulled forward into June and, you know, you had payback in July.
Yeah, right.
But even then, you know, you could any set of data, you know, you can pull apart and find things to suit any narrative.
It just wasn't one set, though, was it? We had the non-farm. You discussed the non-farm payrolls in detail last week. We had the inflation data as well. Looks like Walsh has got the data falling into his lap quite nicely for what he wants.
Yeah, absolutely. Yes. I mean, just looking at the headlines, you could say, well, okay, we've got weaker payroll growth. We've got inflation that's beginning to come down. Not very fast, not very quickly.
Okay.
And now retail sales. So, you know, he's probably, if this was all the data that he had before the meeting, if the meeting was this month, it would almost certainly be a hold.
Yeah.
I'm sure he'd get the votes to stay on hold.
Yeah, it would hold, sit in our hands and wait and see what happens next set of data.
But of course, we got another set of payroll data. We got another CPI and PPI reports. And I think we'll have another retail sales report before the next FOMC meeting, so we'll see what happens.
So it's probably going to bring me on to the first chart that you've got, part of your chart deck, debt to GDP ratios. You know,
well, yeah, it gets back to your first question. You know, what is it? Why is it that the bond markets are so weak?
Are they looking at this chart that's in front of me?
Let's just put chart 1 up on the screen, and you can see this is you know, G7 countries' debt to GDP ratio, which has been going up and up and up over the last few years. Obviously, it you know took a leg higher during the financial crisis and then again during the pandemic. And most countries now are, you know, most in the G7, all but Germany, in fact, are above 100% debt to GDP. Germany is 63% or so.
But last week it was German and French bonds that particularly sold off, the longer dated stuff.
Yeah, that's true. That's true. Japanese bonds did. I can't find a reason why specifically Europe led the sell-off last week. It was a fairly light week for European data. But that said, no economies, no administrations within these countries have the political drive to start reducing debt ratios.
Absolutely none. There's not going to be no reform, is there?
No, it doesn't look, certainly not in the short term. Now, if we look at this chart, you can see Japan's debt to GDP ratio peaked at about 220% and has started coming down. Now, that is because
It's
they
a very
have...
manageable 200 now, is it?
Yes, it's come down from 220 to just 200.
Just 200.
And is predicted by the IMF. This is an IMF chart predicted to drop to something like 195 or so percent of GDP. But what is driving this is not any sort of reform, not any kind of fiscal consolidation. It's primarily reducing nominal GDP growth.
You went through this last week.
We spoke about this last week.
Yeah.
The key, really, I think the key to getting debt to GDP ratios lower is to keep nominal GDP growth running at a faster rate than the interest that you're paying on the debt stock.
Right.
And that is what Japan's doing.
There's no one's going to be voting for reform. So
listen,
cutting
doubt it.
payments to people, it's not going to happen.
No. But I think while we've got this chart up, there's a couple of other things to look at. The US debt ratio, which is currently over 120% of GDP, is projected to move above Italy, which was formerly, the bad boy of Europe. That, I think, is quite worrying, that the US debt trajectory is just on this pretty unsustainable path.
But the economy's fine. What happens when the economy's not fine, or they have maybe head towards a mild recession? What happens then? How much does spending increase then?
Let's jump ahead. I've got a chart to show you what's going to happen when that should we be in that situation.
What chart are we on there, Johnny?
So if we look at chart 4, and you can see, if you look at the unemployment rate and the deficit.
Yeah.
So the deficit to GDP is the red line, and the unemployment rate's the
blue
red line.
Should be down closer to where the unemployment rate is.
Well, the US is running a deficit of 5.5% to 6% at a time of full employment. The unemployment rate has dropped down to 4.1% in the most recent print, and yet the US is still running a deficit of 5.5%, 6%. If that unemployment rate goes up again,
Where's
let's say, you can see on the chart, if it goes up to where, just to, for example, 5 or 6%, the deficit is going to blow out into double digits, without a doubt.
Yeah. And so will the bond market.
And the bond market, is probably not going to like it. So I think, look, people are worried about this, the unsustainable debt trajectory of the US for decades.
Can I ask you, could it be, we know this is not new news, what you're telling us.
No, that's what I'm saying. It's been a problem
probably,
for a long
one
time.
of those things where the straw breaks a camel's back. For instance, AI companies now have come to the bond markets themselves to finance their capex.
Yeah.
That's another seller of bonds coming, and not small, another big seller of bonds
another
in the tens of
on
billions.
Investors' capital. Yeah.
And sovereigns are having to compete with that. And what's the way you compete? You look as though you're better value, higher yields.
Well, that's right. That's part of the problem. I think the other part of the problem is that we've had inflation above target for 5 years now.
Yeah.
And it's like I said, I think the era of persistently low inflation ended with the pandemic, and we're in a world of a deglobalizing world with frequent supply shocks. We no longer have hundreds of millions of emerging market workers entering a globalized labor force. In the US, labor force participation is declining.
That's a source of inflation on its own.
Well, you would think so. You would think that
you haven't seen it
not
yet.
yet. We haven't seen it yet. Yeah. But you would think that companies with a declining supply of labor, with an increasingly scarce supply of labor, companies would have to pay up to get the workers to fill the jobs. So at some point, if the unemployment rate keeps ticking down and the economy is doing okay, you've got to expect pay growth to start heading higher again, which will be a source of inflation.
We've talked about you talked about debt to GDP ratios, but they're going higher. But importantly, there's another big cost coming as they go higher. What goes up?
Yes, you're referring to the second chart. This is a very good point. The red line on this chart is federal debt to GDP. It's you can see it's gone from about 60% at the early part of this century to over 120% now.
And it's projected to go higher again as you've projected
to go quite a bit higher. The blue line is the average interest rate on the outstanding stock of debt.
Right, okay.
Which is currently around 3.5%. But The problem that we've got here is that when the interest rate on outstanding debt was higher, like 5% at the start of this century, the debt stock was much, much smaller. So the total interest expense wasn't that much. We're now in a situation where the debt stock as a share of GDP has doubled, and interest rates are no longer low.
But we've got nominal growth. I'm going to say there's somewhere around about 2.5% and about another 5.5%, maybe maybe even a bit more than that. Isn't that okay?
Well, clearly it's not sufficient, really, because not with a deficit of 6%, and not with I think for the US to be able to get the debt ratio lower with the deficits that they're running, with the primary fiscal deficit, that is just the difference between the tax income and government expenditure without counting interest expense. That needs to be brought down. Either that or the interest expense. The problem is the two have got too high.
And that's why we've got quite a dovish wash at the moment, possibly.
I don't know. I'm not so sure. That is the problem. I think I showed last week a lot of the US debt now is in shorter maturities relative to how it was. The US is issuing more.
Interest rates affect that much more than the longer maturities.
Well, it's not only that. Those shorter term debts come up for renewal much more frequently. And if interest rate, any existing stock of low yielding debt as it rolls off is being refinanced at higher interest rates. The Fed could lower interest rates to reduce the funding costs, but the
long end and the dollar go tits.
The long end yields would go a lot higher. Look, the most important thing when you're trying to get nominal GDP growth up to lower the debt to GDP ratio is you've got to have the long end remaining under control. Most importantly, you need inflation expectations. You need investors to believe inflation expectations
so holding those fixed income bonds is okay.
Yes. You need investors to believe that other investors believe inflation expectations will remain anchored. That's the most important thing.
So could we say this is possibly where it's starting to unravel now? Because we haven't seen the bond vigilantes in like hordes of them. It's just starting to pick up. But I know you've mentioned this before. Are we getting to a stage now where sellers are getting very trigger happy?
They've been rumoured to be lurking in the wings for 2 or 3 decades, and the debt. People are worried about the debt to GDP ratio for the whole of that for a long time.
We've been discussing that for a long time.
And it's never mattered. These kind of things never matter until all of a sudden they do matter.
Yeah, they do matter, yeah. So it's something small that will trigger something to people go, well, I don't want to be like, I don't want bonds. I don't need bonds now, I want bonds.
I mean, the debt clock in Times Square was, I can show you what it is now, but when this was introduced, it was like, it was a clock with a whole load of digits that were winding around.
They had to find a lot more digits.
They had to find more digits, and it's been upgraded over the years. And now I think I can show it live.
We've got live. Oh,
there we go. There's
technology for you, Johnny.
Yeah. So in the top left corner, you can see it's getting on for 40 trillion, but it's going up so fast. You can see just.
There has to be. You can't just keep printing reserves. You can't just keep on this course because the charts are showing you where you're going to get yourself into trouble. 160% debt to GDP, 170% debt to GDP, something then breaks.
Well, there's other issues here. Let me just show you chart 3. This is quite concerning, given current circumstances. Yeah. This is the red line's the federal debt interest bill in billions of dollars, and the blue line is the defense bill in billions of dollars. And you can see the interest bill now exceeds the defense bill. And the interest bill isn't going to start declining because rates are where they are. And the defense bill, if anything...
They're both going north, aren't they?
Yeah, they're both heading north. But very importantly, Sir Niall Ferguson, brilliant economist. Honestly, he's...
Are you going to tell us you know him? You know him? Do you want to tell
I've met him a few times, yeah. Of course,
I wonder when you're going to bring that in the conversation.
Yeah, but he's got... Yeah, I think he signed his books for me. But
oh.
he's written brilliant books on economic history. He really is excellent. And Ferguson's law, he's come up with this law, which is good for, until someone disproves it. But he says any great power that spends more on debt servicing than defence risks ceasing to be a great power.
I suppose he's looking at maybe the older empires, Roman Empire and stuff like that is probably one of those, I guess.
I don't know if he's got a record of their debt ratio back then, but you can look at more recent history to see that that's
UK?
The case. UK. Yeah, I think UK had other issues following the two wars, but, the two world wars did leave the UK pretty much swamped
Bankrupt.
in debt. Yeah.
So
the point about this is that I think investors now are beginning to demand a higher risk premium in order to lend money to Uncle Sam. It's as simple as that.
For a variety of reasons.
For a variety of reasons.
The same ones you've discussed over the last couple of years, and there seems to be new ones coming in as well, i.e. more competitors for the investment.
Yeah, as you rightly say, there's a much greater increased corporate issuance of debt, but there's also equity issuance as well.
Yeah.
I mean, it's a different class of investors.
S&P doesn't care about that though, Johnny.
No, but I mean, there is a need to raise this investment capital one way or another, either through the equity markets or through the debt markets, and if you like, perhaps that private sector capital raising is crowding out some of the government capital raising, which needs to be done. Not so much crowding out, but it's competing with it.
So you've got to pay.
Price.
You've got to pay more if it's competition. You've got to pay more somewhere.
Yes, you've got to pay more to attract the investors to whatever it is you're selling. And I think the experience of the last decade has not been a pleasant one for fixed income investors.
Oh no, yes, you've got a chart on that
and
as well,
I
haven't you?
do believe. I've said this numerous times. I do believe this is not a new normal. This is kind of the old normal. We're in a world of frequent supply shocks. And like I said before, deglobalization. And inflation that's been above target for 5 years. We haven't had that for a long time.
It's almost a reverse of the 2010s, isn't it, nearest damn it?
Yes, it is. I think we are back into more of a kind of 1990s type situation.
Yeah, you mentioned this before, and we've actually talked about this before numerous times. The 2010s was the anomaly, etc. We're now moving back to
the old normal, but at a time when debt stock is that much higher. So it is going to cost governments a lot more to finance it.
And we've got a pretty vibrant world economy.
Well, look, it's like I said, the last 10 years haven't been kind to long-dated fixed income investors.
It's pretty disastrous, isn't it? Since 2022, end of 2022 to where we are now, it's been pretty shocking.
The blue line there is the Bloomberg long-term Treasury Total Return Index.
Could you just explain that briefly?
Yeah, so that index captures a kind of an investment in long-term Treasury bonds where the coupons and any redemptions are reinvested into the index. And so it's showing you the total return. And all these indices are normalized to 100 at the start of 2016. So you can see the total return from long-term Treasury investment
is less than zero. Is a negative.
Yeah, you've actually lost money. Now, part of that is because back in 2016, you were buying Treasuries that were yielding, probably around 2%.
Right.
And
so you've lost money in the price.
You've lost. Obviously, the value has gone down. You've lost money there,
and the yield hasn't made up the difference.
The running yield hasn't made up the difference. Obviously, as the stuff's being reinvested, as maturing bonds, some of your portfolio is maturing and being reinvested at higher yields. But even so, over the 10 years, you've lost money.
So how does this? So you've got a 60-40 portfolio, Johnny, and the bonds are supposed to be the safe bit, and they're not.
Well, for the last few years,
they must have severely underperformed. Well, saying that the equity content has been good.
The equity, has been, and there is still. Look, I mean, in theory, the 60-40 portfolio will protect you if, for example, there is the kind of event where the economy gets a sudden hit, and people
rush for the bond market.
the safety of the bond market. Equities go down and bonds rally. we may, the worst case scenario would be where we get a fixed income sell-off because people are concerned about inflation or
and it brings down the equity market with it.
And it would bring the equity market with it.
Yeah.
And if you look on this chart, the red dotted line is the consumer price index. And in other words, that is showing you how far prices have moved, centered on, starting at 100. The consumer price index is now up about 45%. That's how much the average price level has risen over these last 10 years. Even
short-dated bonds have been not left behind, but are just about keeping in tabs with it.
Well, short-dated bonds, that is the risk-free rate. This total return index captures bills that mature within a year. So this should be the risk-free return that you can get from the treasury market. And yeah, it's returned something over the last decade, but it hasn't kept pace with the CPI, but it has massively outperformed long-term bonds. And I think, if you're just looking at this last 10 years performance, you would have to say, if we get anything like that again over the next 10 years, I'd rather have the money in short-term paper.
Yeah, yeah.
The alternative, I have to say, the alternative that looks like a much better bet to me is tips.
Tips. Yeah, we discussed that before the program, didn't we?
Yep, because the 10-year tips are yielding something like 2.4%, 30-year tips yielding 3%. Those are pretty good yields. That you get paid whatever the CPI is. Super safe as long as the US doesn't default. You get paid. If
that 10-year tips does look quite attractive, doesn't it?
2.4% plus the CPI each year. That's what you're going to end up with over the 10 years. That's the kind of yield. It looks attractive as long as you trust the government to be able to repay you on that basis.
Yeah.
I mean, assuming they don't default, I think that's a much better bet. I'm not suggesting they could or would, but, who knows? Something could be changed in terms of the way the CPI is calculated or whatever. I don't know.
Treasury yields.
Yeah.
I think that most people know you think they're going to go higher again from here. That's what your thought process is. Maybe not in a straight line, but they're going to go higher. I can see on the last chart you've got here, it's one of your favourite ones.
Yeah. Well, yeah. Okay.
You have it I think we discuss it most weeks we're here, and you've made it very clear, and it's a chart I keep on looking at, that the ceiling on the 10-year and the 30-year being 4.5% and 5% respectively now looks like it's acting like a base.
Technical analysis, I think, is really best when it supports your fundamental view.
Yeah. Not on its own. There has to be both sides of it.
As long as you've got a strong fundamental view to start with, you can then look at the technicals. And I'm no technical analyst. I just, draw some straight lines on a chart. That's the extent of my technical analysis. But this is fairly compelling what you've got here. Yeah, I think the point I was trying to make was that in the past, people's expectations were anchored by by experience. Everyone has biases. Everyone has confirmation bias. You look for signals in the data that confirm a prior held view.
Oh, I see. Okay.
So for a long time, many investors would have said, well, okay, 4.5% on the 10-year.
That's pretty
decent.
That's
a great yield, or 5% on the 30-year.
Because they were used to the ultra low 2010s to 2020.
That was the environment we're in.
That was yielding 2.5 then, or even in fact, it got down to less. What did it get down to? 60 basis points, the 10-year?
Something like that, yes.
So 450 basis points seems like a bonanza. It's like a bonanza fully boots.
Yes, and not only that, it was a 10-year period of kind of sub 2% yields, mainly sub 2% yield.
Engineered by central banks.
Yeah, to some extent engineered by central banks, but also the financial crisis that left demand extremely weak. It was a period of balance sheet repair.
Yeah.
Really.
They had to do something, and they threw everything at it.
They threw everything at it. But that came to an end, and now I think point of mentioning expectations, confirmation bias, is that the data previously, any set of data was viewed in light of inflation is low and stable, and you would look at anomalies in the data There's always anomalies in the data, but you could pick the ones that kind of supported the prior held view. And that was why this most recent set of data kind of surprised me. There was enough in this recent set of data to be able to make a case. Well, okay,
I'll own some treasuries now.
Yeah, Walsh has got this right.
Yeah,
there's no need for any hikes. Inflation is heading back to target. The economy is not ripping. It's time to invest in fixed income.
But the investors didn't think that way. Didn't see that way.
The treasuries just couldn't hold a bid.
No, not at all.
It was like there was just a wall of sellers.
I think they're lower again today as well.
Yeah.
As we're speaking on the Monday.
Yeah. So I am of the view that this could go a lot further. It's difficult. It's very, very difficult being short of anything in when it comes to trading, because the upside is, well, not so much for rate in the rates market.
Equities that's a struggle.
Equities, the upside is unlimited, but it's still quite difficult in the rates market. You're paying away carry the way things are at the moment.
Yeah.
With the yields higher than the overnight rates. So it is a difficult trade. But what I would say is that option implied volatility is still at rock bottom rates. So wherever you can, it makes sense to protect your positions with options.
You can keep with a position longer with the options, because it's got a natural stop in it in itself.
That's the thing. It does help you stay with the
and
position.
we're talking about short-term options here, aren't we? Like 2 week, 1 week, 1 week treasury options.
Yeah, or even 1 month. But the thing about this particular treasury sell-off is it's kind of happening in slow motion,
which doesn't necessarily. So you could do spreads rather than doing an outright. That would probably. So look, Jonny, we discussed quite a lot about the fixed income market, longer term fixed income market. Can you just summarise in say 2 sentences what we've gone through today and what you're thinking?
I think, in summary, that the 2010 era of low and stable rates, low and stable long-term yields, and below target inflation, it's over. That ended with the pandemic, which ushered in a period of deglobalization, persistent supply shocks, and a level of inflation that is just eroding the value of long-term investments.
And just to be clear, this is your opinion, not
investment advice.
Not investment advice.
Just my opinion.
And tell me, the punters watching, where can they?
So if you want to
see you, get hold of you.
Yep. By all means, I write a daily note where I go through the day's economic data, the previous day's economic data, what it means in terms of the economy and markets. And on the weekend, I do a much more detailed analysis of the major regions and the markets. So you can find me at super-macro.com. You can take a free 30-day subscription, £50 a month after that. And you can follow us at super_macro. That's correct. Take a trial subscription, sign up, see what you think.
Thank you, Jonny.
Thank you, Elvis.